Good morning, everyone. I'm David Martin. I'm the Business Development Manager for Realty Services, which operates the Eves and Bailey's brands. And this morning I have with me Clive Martin from Lifetime Mortgage Brokers and Insurers. And Clive's going to talk to us today about what they're seeing in the marketplace in terms of what buyers may need to be doing. But the reason I've asked Clive to talk today is because he's been in the industry for 32 years in banking. He's a specialist mortgage advisor, and I know from my experience working with him and with him working with our people that one of the reasons why people employ Clive and continue to go back to Clive is because of the very personalised service and excellent advice that he gives them. But don't tell him I said that. Because his objective really is to make sure that the client understands what are all the options and what's the best option for them. So as a salesperson or as a member of the public, you know, if you're thinking of buying again, then it's good for you to be in charge of the full facts as at this date. So Clive, you know, it's been a very interesting time in the marketplace. And we know that there are some competing forces at the moment in terms of, you know, quite low interest rates, you know, historically low interest rates, and the loan-to-value ratio is also now being removed. Yes. But on the other hand, we're seeing banks stiffen their criteria in many respects, or indeed change their minds about what their criteria will be without necessarily communicating that to the marketplace, which I think puts you in a unique position, doesn't it? Because you have a panel of banks that you talk to,
correct,
which then enables you to give good advice to purchasers based on your findings across that panel.
Yeah, absolutely.
Okay, so tell me, let's start with the lifting of the loan to value ratio restrictions and its impact on home lending. Tell us about that.
Okay, so we recognise and understand that COVID-19 presented us with unprecedented and challenging times, and certainly in the finance markets, not just locally but globally. And one of the things that came out early on in the piece with COVID-19 was the government calling for the banks to offer some assistance and guidance, and hence there were a call for the banks to come to the party with assistance to clients who might find themselves struggling a little bit with where they saw their incomes, where they saw their certainty of meeting the repayments on existing mortgages. And you might remember that the banks came out with a range of offerings, and in particular the media made a lot of noise about mortgage repayment holidays, which the banks quickly corrected the terminology of to mortgage repayment deferments. Now effectively that just suggested that clients could effectively stop their mortgage repayments, both interest and principal, but in reality what that meant was that those mortgage payments would be capitalised to the loan balance, and the term that was offered for that particular facility was up to 6 months, so meaning that over a 6-month period clients would find themselves not having to make any mortgage repayments, but in fact those payments would be capitalised to the loan balance, finding that at the end of 6 months their loan balance would be significantly increased.
Right.
Now I understand that all the banks had a significant inquiry for those mortgage repayment deferment programs, which in itself created a little bit of concern with the banks about the level of exposure that they might find themselves with. You might remember also that there was quite a bit of media commentary around what house prices might do as a result of COVID-19, and media saying that house prices were going to fall and plummet and all those other words that they seem to come out with from time to time. But what that did was trigger some concern with the banks around their LVR positions. So the LVR restrictions were imposed on the banks by the Reserve Bank, and essentially said to the banks, look, thou shalt not lend more than 80% of the value of an owner-occupied home, and a further restriction to 70% for residential investment type properties. The banks quickly realised with all of these deferments that a lot of their lending exposure was going to exceed those LVR restrictions, which essentially might put those banks in breach of their banking licence with the Reserve Bank. So discussions were had with the Reserve Bank to determine what could or should be done about that. And of course, once again, the media got onto that bandwagon and suggested that the Reserve Bank would remove all the LVRs and that lending would become a whole lot easier. In fact, the banks were already concerned about their level of exposure. So in reality, whilst the Reserve Bank agreed to remove the LVRs, the banks stuck to their in-house procedures and criteria for lending, and in our case, several inquiries we made of banks suggested that they were adhering to the 80% and 70%, and in fact in a couple of cases the banks had tightened that policy, restricting investment lending particularly to as low as 60%. So what that meant for buyers, what they were confused with the messages they were getting, one from the media and two by approaching their banks and finding out that in fact nothing had really changed. And I think from our point of view it was important to understand the background and understand what was going on so that we could guide clients in the right direction when it came to LVR restrictions. And we've certainly had a lot of inquiry around that, so it's been very helpful to be able to steer clients in that path.
Okay, so interest rates have come down. Some restrictions have been removed in terms of LVR, but criteria have actually, in many cases, got a bit tighter.
Yep.
Okay, so as a potential purchaser, is it easier, as a generalisation, for me to get money than it was before, or has it actually not changed at all?
Yeah, look, I'd have to say that it's become more challenging, David. It's certainly harder to borrow money, and probably not just because of the LVR position, but we're recognising that interest rates are historically low, and a lot of perception, therefore, is that because interest rates are low and people button into the publicly available mortgage repayment calculators and realise that repayments are actually pretty good. But the reality, of course, is that with the concern and the uncertainty that the banks have around their lending exposure and the impact of these mortgage repayment deferments, that they were pretty keen to keep the reins on in terms of loan assessments.
Okay, so you mentioned a number of things there, and it sounds like banks then have other things that they consider in terms of when they're assessing home loans. So is there anything more you want to add to that?
So let's just take the interest rates and the comment that I made about, currently interest rate historically low, 1 year fixed rate space around the 2.69, 2.79, somewhere in that space. And the reality of all of that, though, is that the lending proposals are assessed for affordability, and the banks have done for some time, in fact, use much higher rates. The historical norm for interest rates for home lending over the last 30 years is about 8%, and the banks for some time have been assessing affordability at between 6 and 7%. And that's purely just to get a comfort feel for what if interest rates do potentially sneak upwards. And so the affordability test is assuming that if interest rates get to about 6 or 7, then the clients are still in a pretty good position with their income levels as disclosed to meet the repayments if rates go up. So the banks all test affordability at a much higher rate than the current market rates, and in addition to that, where the risk exposure starts to increase, then the banks impose some other in-house criteria around what they feel is appropriate in terms of the affordability. I guess all of this comes under an umbrella of what we call the Code of Responsible Lending. So the banks are required to be responsible lenders and ensure that people can afford the commitments that they're entering into.
Right, okay. Well, that makes sense too. So for those people thinking about buying a home in the next few weeks or months, when is the best time for them to approach their bank, or in my view, approach somebody like yourself to make sure that they're getting the best arrangements possible for them?
So let's look at first home buyers first. It's important that if there is consideration of a first home purchase, then get in early. Get into myself, the mortgage advisor community, or the bank, and ensure that you start preparations very early. You will need to determine your access to KiwiSaver and potentially the access to the first home buyer grants, the free gift made available for first home buyers from the government. You will also need to present information around your income levels and to determine what other commitments you might have. Many first home buyers have availed themselves of student loans, and all of those commitments will make an impact on the assessment of affordability that the banks undertake. So it's important to get in early. Once you've got a pre-approval for lending to move towards the purchase of a property, the other major consideration for buyers is to ensure that the bank is happy with the property that you select as security for its lending.
Right.
That appears to be a significant obstacle in some cases where we do have some problematic property, but also property that may not have been properly altered or added to with council consents and compliance.
Right.
So it's important that as a buyer you make contact with the bank early, not just for pre-approval, but to ensure that the bank's comfortable with the security for the lending requirement.
Okay, so it's not just a simple matter of finding a house and buying it. There's these other components that a buyer should consider as part of their overall plan.
Absolutely. Now, one of the other things that the bank is particularly interested in during this early process is to ensure that your income levels are at a level required to service the borrowing, and as I said, assessed at much higher interest rates. And it's important, therefore, that a potential buyer, demonstrates that they have that income available to meet repayment. And so there's certain behaviours that I would suggest are particularly good tips. One is that if a young first home buyer particularly is serious about buying a home, then they need to demonstrate that seriousness to the bank.
Right.
My suggestion is open up a bank account, call it the house account, and start putting $100, $200 a week in it on a regular basis. That does two things. If you're paying rent already, and let's say you're paying rent at $400 a week and you're saving $200 a week, there's a clear demonstration that you can afford $600 a week in mortgage repayments. The other thing is to make sure that you behave. By behaviour I mean make sure your account operates as it should at all times, make sure that you're not spending money frivolously, and perhaps as a subtle tip, and on occasion you might withdraw cash than using several EFTPOS transactions. So just make sure that your account behaviour is becoming of the bank looking at your integrity to repay a home loan over the next 30 years.
Right. Good advice, very good advice. So just in summary, is there anything else you'd like to add?
Yeah, look, I think the important thing is to get good advice and to get the right advice for you. I'm all about making sure that clients get the right advice for their particular circumstances. Everybody's different, everybody has different circumstances around their positions, but it is important to match lending facilities to individual circumstances. And what is really important, once we've got everything in place, is to make sure that longer term you're in the right place to be repaying your loan off early if that's possible and putting yourself in a stronger position to make the next moves in your future. Hope that helps.
Very much. Thanks very much, Clive. Really appreciate your expertise in this area and your advice to our listeners. If anybody would like to talk to Clive, Clive can be reached on 022 1234 270. Thanks for watching. Talk to you again soon.